Hey, hello, Jack Tubbs from the J Team at Realty One in Surprise, Arizona, coming to you on this really warm Wednesday. Hey, I hope that you are all inside in AC or you are in the pool staying cool. Want to finish up with what I started yesterday. We're talking about lending terminology, especially for you buyers out there, first-time buyers who've never really explored all the different lending products that are out there. And I do mean products. I mean, there are so many different styles of conventional loans and different balloons and different interest onlys and all these other things. And you need to have some basic idea of the terminology that's used around them so you're not completely you don't walk out of a lender's office just totally with your head spinning. So if you understand some of the lending terminology, it helps you when you're moving forward and help understand what they're talking about when they talk about different types of loan. Now, of course, yesterday we talked about what the term was, which is the length of the loan, whether it's a 15-year, 5-year, 30-year mortgage. Fixed versus adjustable rate. Fixed rate being the same interest rate through the entire term of the loan, 15 years, 30 years, 5 years, whatever, and then adjustable rates, which it adjusts with the bond market. Non-traditional mortgages, these are exotic different things, and some things that really are not great things for first-time home buyers. There used to be the no-doc loans and all these other things, and then there are private lenders that are out there that have all sorts of different kinds of loans. And then I've even worked with a client that didn't have the greatest credit, but they had great income, but so they were willing to charge them for the first, I think, 18 months, year and a half, a really sky-high interest rate, and then it would drop down to the normal rates after they had made their payments on time for the first 18 months. Balloon mortgage, basically interest only with the balance due at the end of the balloon term, which is usually about 7 years. Now we're going to talk about all the different government-backed loans. And now there's a whole bunch of them. You have Fannie Mae, Freddie Mac, which are the guarantors, I would say, of different loans. In other words, they made sure that the lender who gives you the mortgage, they will guarantee up to 20% of whatever the mortgage balance is should you default, so that the lender has a chance to recoup what they've lost should you be foreclosed on, should you default on your loan. And they want to make sure they don't get caught in a place like they were back in 2008, 2009, when values fell off the cliff, even with a 20% guaranteed by the Fannie Mae or Freddie Mac or by FHA, they were left still at a loss. So that's why they really tightened up their lending criteria so that you've got a lot more hoops to jump through, a lot more credit worthiness to prove before they're going to approve you for a loan or even pre-approve you or pre-qualify you. So, but there are a whole bunch of them. And now there are a whole bunch of agencies like I just shared with you. There's the Fair Housing Administration, there's the Veterans, Department of Veterans Affairs, all these different, now the FHA or Fair Housing Administration, basically they're an umbrella organization that also works with Fannie Mae and Freddie Mac, which are government entities right now, or actually they're in receivership right now, and they guarantee to lenders such as Wells Fargo, Bank of America, Chase, whoever gives you your loan, they will insure the loan with a guarantee that they will pay up to 20% over the loan value should you default. Okay, you pay the FHA insurance. It used to be just until you reached a 20% equity stake in the property. Now it is for the life of the loan. And what most people are doing is when they know that they can refinance and have 20% equity in the house, they're basically getting a conventional mortgage, dumping the old FHA mortgage, paying that off in full, and not so they can drop their payment and not pay those insurance premiums which are associated with an FHA loan. Now you have the Department of Veterans Affairs. Now those are for all the loans that are what we call a VA or a Veterans Administration loan, and those are open to basically active service members, retired service members, sometimes their family members, other people that work for or involved with the Department of Defense or the Department of Veterans Affairs. And basically what's really unique and what's nice about these loans, they're a zero-down product. They have a very favorable interest rate. As a purchaser, you don't pay for all the inspections that are normally paid for by the buyer. Some of these have to be paid by the seller. Also, a little bit more stringent inspection. They want to make sure that the home is definitely worthy Don't have to worry about any problems with the major mechanics of the home, such as heating, cooling, water, electrical. All doors must shut and seal. No worries about mold or other infestations in the house at all. Also, some of the closing costs that are traditional with any other home purchase are waived by the Veterans Administration. Make sure that they're waived. They either get paid up by the seller or they're just waived by the lender and the title company completely. Then you have the USDA, the United States Department of Agriculture. They have their Rural Development Loan, which is basically the program was started to for the survival and the continuation of family farms, and basically any place that is outside of certain population parameters. The rural development loans are available, and once again, they are a lower down payment to zero down payment, favorable interest rates. Help a lot of people that are going to live in smaller towns find a home, be able to purchase it, and have a favorable interest rate with very little money down, so they can help with the money they have that they can use for closing costs and things like that. Really a neat loan, but it's also regulated by the United States Department of Agriculture, which seems kind of strange, but nonetheless, it's a very unique and very helpful loan or lending product, especially to those who want to be a little bit more out in the rural. Now, as far as FHA loans go, that are basically backed by Fannie Mae, Freddie Mac, they also allow for lower down payments as little as 3.5%. They do call for a little bit more stringent inspection of the property than, say, a conventional loan would. But the main thing here is that a lower down payment, you don't have to come in with 20%, but you do have to pay those mortgage insurance premiums until you either refinance or you'll pay them through the entire value of the loan. FHA loans used to be assumable. They're no longer assumables. If you find one, it means that somebody's been carrying that loan for a very long time, but they are not assumable anymore. But once again, they are government backed. I hope this helps, gives you a little bit of knowledge of, when you go to talk to your lender. And as I always say, if you want a referral to one of an excellent lender here in the Valley, I work with 3 fantastic lenders that'd be more than happy to help you. I have a couple of them that do specialize with VA and rural development. So if I can refer you to them so that you could find out even more and they can help get you qualified to purchase your new home, please give me a jingle. You can call me direct at 248-330-7972. That's 248-330-7972. Or you can email me, Jack at thejteam.house, and that's JACK at THE, the letter J, the word team, TEAM.house. That's HOUSE. You can call the office and talk to any of my team members at 623-252-4061. And that's 623-252-4061. Hey, this is Jack Tubbs from the J Team at Realty One in Surprise, Arizona, wishing you a beautiful Wednesday. Get in there and get cooled off in the air conditioning, and I'll see you tomorrow with more about what's going on in the Phoenix real estate market.